Good afternoon for everyone on the East Coast, and good morning for everyone on the West Coast, and hello to everyone in between. This is Lauren Kelly from OPEXEngine, and thanks for joining us for our September monthly SaaS benchmarking webinar. We today will be talking about SaaS sales compensation structures, looking at some of OPEXengine's recent research in that area, but more importantly, speaking with our invited panelists to discuss some of these topics. But before I get into that, I'm just going to talk about a few housekeeping things. Everyone who is listening today is on mute. If you have any problems with that, try making sure that your computer audio is turned off. Feel free at any time to send in questions through the chat functionality, and some of those questions we may be able to answer as we're going through the discussion, and some we'll certainly have time at the end. So without further ado, I'd like to introduce our panelists. As I said, I'm Lauren Kelly. I'm the CEO and founder of OPEXengine, and OPEXengine is a benchmarking data platform dedicated to software and SaaS companies. We cover financials and operating metrics for over 200 metrics and help companies understand where they stand in comparison to their peers and also their planning. Today we have with us Eric Stevenson, who's the Director of FP&A at Domo Inc., and Steve McKenzie, who's the former Head of Sales at Insight Squared. Steve just left Insight Squared. And let's start with Steve. If you could just introduce yourself real quick to the audience, we'll get started. Thanks. And Steve, you may still be on mute, so we're not hearing you, so you may want to turn off the mute.
Hi, Lauren. Can you hear me now?
Yep, that sounds good to me. Thanks.
Great. Thanks. Hi, everybody. It's Steve McKenzie here. Yep, I've just finished up after 3 years at Insight Squared. Prior to that, I was with a company called Mimecast. So I've run sales organizations both here in the US, in the UK, and my home, which is South Africa. For my sons. So I've been doing this for a number of years now.
Terrific. And Eric, do you want to give us a little bit of introduction about yourself and also Domo? And hopefully you're not on mute either. I'm not hearing anything quite yet. You want to? There you go. Are you on, Eric?
Eric, you might need to push *1. That's how I became unmuted.
Can you guys hear me now?
Yep, that's great. Thanks.
I didn't know about the *1 trick. Thanks, Steve. I'm Eric Stevenson. I'm the Director of FP&A here at Domo. I've been at Domo for about 3 years now, and previously I was at Ancestry.com. And brief introduction of Domo. For those that might not be familiar, we're kind of a BI platform. We provide data visualization and analytics, as well as a lot of other tools for the business. We kind of consider ourselves, or at least our CEO considers ourselves, the business cloud, as we have a lot of different tools to collaborate with the various departments in the business. So. Yeah, that's me.
Great, thanks, Eric. And for anyone on the line, if they want to check out Domo or Insight Squared, both great companies, and we work with both companies, so we're excited to have you both on the line. I'm going to take 2 minutes and just give an overview of OPEXengine, because we do have some folks on the line who are not participants in the benchmarking community. OPEXengine is a data platform, a give-to-get subscription, totally confidential. We are independent. We're not investors. We're not selling anything else. We're a group of folks in the Boston area who all came out of the tech industry and have built some fairly large companies, and we felt that there was a lack in the market for good quality, dedicated benchmarking data, and so that's what we do, and we've been doing it for a long time. We work with hundreds of companies, and so We cover over about 200 metrics for every department of the company, typically, and key SaaS metrics, and then we provide you with over 60 different peer groups to compare yourself against by size of revenues, by average contract value, amount of invested capital, if you want to look at it that way. And as part of the subscription, we also hold these monthly webinars where we usually invite some of our customers to talk, just because our focus is all on how to run your operations more efficiently and grow faster so that you can, not worry about trying to find information. You can focus on doing what you do best, which is figuring out the right model for your company. And the other thing that we do is quarterly research on specific topics that we take a little deeper dive. So Q1 of this year, we looked at sales ops and sales ops structures. In Q2, we looked at SaaS sales commissions and commission structures, which is what we're going to talk about today. This is a closed research resulting for our subscribers, comparing overall compensation per person in the company and for each department in the company. And then in Q4, we're going to talk about R&D productivity and look at different how companies are tracking that and make some comparisons based on some new metrics that we're putting together. So we're quite excited about that. But to give you a quick overview of the research that we did, and then we're going to dive into the discussion with Steve and with Eric. We ran the survey in the second quarter of this year. All of the data was based on the most current information from companies. And then for all the participants, we deliver a full report. And for the companies that are actually paying subscribers, they get a little more individualized report that shows them compared to their closest peers in terms of sales comp structures. So the kind of things that the research was focusing on was looking at variable compensation by different positions. So what's variable percentage of OTE for new account reps versus renewal reps versus management, quota to OTE multiples, as well as any changes to commission rates planned this year, and then what pieces are in the comp plan. So we worked with a wide variety of companies from $1 million up to about $500 million, and a few companies even larger than that, and a range of growth rates in terms of the companies that participated in the benchmarking. So one of the introductory things that we looked at is how many companies have dedicated channels within sales as compared to just direct field sales. And as you can see, almost all the companies had field sales, and only about half the companies have partner sales organizations. But I have to say this is up from when OPEXEngine was starting out about 8 years ago, when a lot of SaaS companies didn't even have anyone doing any kind of partner sales. And then about sales structure a month, and that. So as you can see, not huge variations. About 30% of the companies, a little more than 30%, or more than a third, work with annual quotas, and about 30% with quarterly quotas. and slightly less than that have monthly quotas. So it really is all folks in the annual quota bucket are selling, larger contracts, annual contracts, and all the folks in the monthly quota time period are selling, more transactional, smaller average contract values. But it was kind of interesting. There was no obvious business model association for the quarterly. You see a real mix there. Then in terms of the basis of commissions, another area that we get a lot of questions is, do you base commissions purely on bookings? Do you add in some aspect about payment or cash? Or is it the invoice amount, or recognized revenue, or gross margin, or some other element? So that's actually a great question maybe to start off with Eric and with Steve. So Eric, at Domo, are you paying commissions on bookings, on payments? How does that work?
Yeah, so we have a little bit of a mix, but primarily most of our commissions is paid on bookings. There's some cash incentive for the reps if they get more than a year up front, but that's pretty small. So most of it, I'd say majority of it is on bookings.
Okay.
Do you want me to jump in here? I think we're similar to us. What we did was we actually had a very generous kicker. I've run this twice actually, where it was on bookings was predominantly what commissions are paid on. There is usually a clawback if something happens and the funds are not collected, because you can't pay commissions if someone renegades on their agreement on their contract. So bookings is a primary driver. And then there were pretty generous kickers for deals paid in advance. So when I joined Inside Squared, most of the agreements were paid monthly, and then we flipped that into annually paid in advance. It just makes a huge difference to the business. And then secondly, we paid pretty generous kickers if you've got 2 years paid up front or 3 years paid up front. Did this both at Mimecast in the early days as well as Inside Squared for a little while. And it's a really nice sales tactic, because if people are able to give you that much cash up front, it really helps you with your operating expenditure requirements. So if you can do it, it's great.
Okay. No, I think that makes a lot of sense. I mean, it's always been, and sorry, I apologize, I'm getting some feedback from a few folks who lost audio, I think, but it looks like everybody is back on. If anybody's still having problem with audio, if they could shoot me a quick chat, we can do that at the same time. So in terms of the other area that we looked at in a lot more detail, but this is sort of a summary chart, is what are the different elements of a typical comp plan? And specifically for your own company. So 91% of the companies have accelerators. It was interesting to me that there were any companies that didn't have accelerators. And then over 50% have clawbacks. Less than 20% use deaccelerators. Most of those companies implement deaccelerators, because this is another question that we asked in the survey, below 100%. So if, for example, you get less than full commission or full credit for whatever you're selling at below 50% of quota or below 60%. We did see a few companies that had deaccelerators over 100%, but given that this is such a growth industry, you don't see that much of it there. And then, similar kind of thing, caps. So that would be interesting, Eric, to hear what you're doing at Domo. I mean, certainly Domo's been on a very strong growth path. So what do you do to ensure that you're keeping the salespeople motivated and in terms of the different structures of your plan?
Yeah, so we've done some different stuff, and we've talked about a handful of different things. So we're probably somewhat traditional in that, we certainly have accelerators. 0 to 100% is paid at the same rate, and then once they get beyond that 100%, then that's when they start kicking into the accelerators. We don't really have any deaccelerators, I would say, for the most part. We did talk about that this year and had potentially, we had kind of drafted it in, at least from the FP&A side and with our CFO, but ultimately it was going to be just a challenge and kind of a headache the way they're structured, trying to pay out less, 0 to 25%, 25 to 50. So that's why we didn't go down that route. But I think it's still, I think it's a good option. But so we have the traditional accelerators, I would say. In theory, we claw back. I think we're pretty generous to our salespeople for the most part. So we kind of take, I'd say, one deal at a time often, or depending upon the situation. But in theory, we do claw back as we do. We pay commissions up front once a deal's sold. So if they don't pay, then we look at that and typically we'll claw back. The big, I would say the big incentive that we have, and this year we increased it quite a bit, is the multi-year deals. And Steve talked about that a little bit, and that we do pay, quite additional commissions on deals that are sold between 2 and 5 years. And that certainly has, we've seen quite an uptick this year because of that incentive that we kind of boosted this year. And then the last thing that I'll say, as you talked about the annual quotas versus quarterly or monthly, and we talked through that this year, and we've done annual, and we had considered making some changes in 2017, but ended up sticking with the annual quotas. But we have some quarterly bonuses built in to hit certain levels. So kind of what you were saying, Lauren, to try to keep at least some consistency in the quarters, we have bonuses built in if they hit 1 quarter or 2 quarters, which is kind of a breakdown of their annual quota. They can get additional bonuses for the quarter. And then the last thing is we're always kind of changing spiffs. Each quarter we review where we're at, what things we want to motivate, what challenges we have, and we'll introduce different spiffs. And we've done that where every quarter we might introduce a new spiff and drop an old one, or whatever the case might be.
Yeah, and that's something I've worked with, and it's worked well for me in the past. Have an annual quota, but have quarterly tied to some, whether you use bonuses or somehow associate it with the commission, and accelerators or deaccelerators to some kind of quarterly targets. Yeah. I have a question here before we move on, going back to the question about what you pay on and paying on bookings. Is it TCV or?
Yeah, we pay on TCV. So and that's a little bit of what I was talking about. And we've historically paid on TCV, but the incentives weren't quite as great. This year we changed those up a little bit, and our TCV has gone up quite a bit this year because of the incentives we put in place. So yeah, all the reps are paid based on TCV. I mean, the years though beyond the first year, of course, had a different rate, but we do pay on TCV.
Okay, and I actually do want to dig into that, but I want to hear from Steve a little bit about what elements he was using at Inside Squared, and also maybe on that same question.
Yeah, so I think not too dissimilar. We would look at, if you think about where it starts from, it all starts from what are your bookings goals for the year. So normally between the executive team, there's an annualized goal, which then gets ramped down into annualized goals down to the individuals. We did go through a phase where we said, look, we're going to reserve the right to change the goals and the plan on a quarterly basis, but the administration involved in doing that is a real pain in the butt. So it ended up being an annualized thing. The other thing to consider is as you look at the goals, is are you seasonalizing the goals? So are you having a flat monthly bookings goal, or is that goal aligned to how you normally perform over the quieter summer months and the busier end of quarters and the like? And then you have a percentage multiplier aligned to that number. We did quarterly accelerators, so you would get paid your rate, and then we would look and see how you performed. And if you went over 100% for the quarter, then you got a kicker. In terms of the multi-year deals, there were 2 components to that. One of them was multi-year deals paid in advance. In other words, 3 years of cash received. And then what you would do is you would get a kicker rate based on that. And we actually paid, if your base rate was say 10%, but you got all 3 years paid in advance, we would pay you on that the total contract value of the 3 years at that rate. So you would get effectively 3 times the ACV, the 3-year deal. And then there was a different kicker if it was a 2 or 3 year deal paid annually. So we also wanted to reward longer term contract terms, not just cash received. We didn't have any decelerators or deaccelerators, but I have run that play in the past where below, I think it was below 75% or below 50% of your monthly goal, your rate was less. It was about half of what it was. But you were able to very quickly claw it back as soon as you got over 50%. And I agree, I think administering that does become challenging. It can be effective, but you've just got to make sure from an administration standpoint you've got all your ducks in a row because it starts to become a little bit complicated. And then similarly, same as Eric, what we'd look at doing is at the beginning of each quarter saying, are there any particular behaviors that we want to drive? Let's create a spiff to drive said behaviors. And I'm actually a fan of that. I think maybe we could expand that topic out at a later part in this call, but I think that one of my things is that we often find people try and complicate compensation plans by putting in too many components to it. I always believe that as far as possible it should be very, very simple. And then if you want to try incentivizing behaviors, I would always encourage to do that via short-term spiffs that can be added in and taken away.
Exactly. I think I was thinking as you said that about you've tried the deaccelerators, but it sometimes can become difficult to administer. And I think, in my experience with both smaller as well as some larger sales organizations, and this is a role that the finance folks could play really well, is that before you make the plan, any complexity you add to the plan, you really should run some models and just some checks to see if adding that complexity actually saves the company any money at all. Because any complexity always creates some kind of friction in the salesperson's mind and confuses them. So there has to be a real benefit to the company in some, meaningful way, at least dollar-wise, I think. So if it's just going to add, a minor benefit of reducing a little bit of payout occasionally, but it's going to confuse people in trying to understand that element of the plan, my experience is it's totally not worth doing it. So that's my 2 cents. The other area that we asked companies about is what the purpose of their comp plan goals are, and I wanted to kick off a conversation among everybody, and I'm happy to also include anybody who wants to write in questions on chat. But funny enough, almost all the companies said that the primary focus of their comp plan is to get revenue and to grow the company. About 73% of the companies said, another major focus of our plan is new customer acquisition, which again, think about our industry in the SaaS industry, one of the highest growth rates of any industry in the world. That's significant. But, expansion revenue, 50%, so companies are following the land and expand model with those two elements. And then, just under 50% of the companies said they're interested, as you both have been talking about, in longer contracts and in doing things in the plan that compensate, incent, and motivate the salespeople to get longer contracts. And only 25% were focused on cash up front. So I think maybe that's where I'll jump off and move to, talking to everybody about, how do you go about getting your management to agree on what are the goals of the plan? Because if you have a lot of conflicting goals, it typically leads to a really bad comp plan. So with that, I'll start with Steve this time, and what are your best practices, both at Insight Squared and also at other companies you've worked at, in just making sure that the CEO, the CFO, you as the head of sales, and everybody else of importance is, agreed on what are the goals of the plan?
Yeah, I think it's I would always say over-communicate. When you're dealing with someone's paycheck at the end of every month, it's a very sensitive topic. And so what we shouldn't do as executives, both sales leadership and finance leadership, sit in a room and come up with what we think is a fantastic commission plan and then just roll it out, and I've seen it happen, where you just put up a PowerPoint presentation and say, here's the commission plan. I think it's very, very important to educate the team as to how the plan was formulated, why it is the way it is, so that there is a degree of business logic that is associated with it. Because most salespeople, when they see a change in commission plan, their first thought is, oh no, how are they going to try and penny pinch us? How are they going to try and save a bit of money for the company and take it out of our pockets? So I think that once you've decided what it is that you want to achieve, why it is that you want to incentivize those particular behaviors, how it is that you got to the goals and ultimately the commission plan, showing some benchmarks and the like, so you can prove that you're in the right ballpark as it relates to the rest of the market, and you'll have a far better buy-in from the sales folks. And then just again going back to the kind of keeping it simple mantra, the minute you start adding too many components and too much complexity to it, salespeople it becomes irrelevant. It doesn't drive any behavior, because the default setting for a sales professional is, I think I'm supposed to sell stuff, so let me go and sell stuff. And this commission plan, if it's super complicated, I don't really understand it, so I'm just going to try and sell as much stuff as I can, and then I'm going to hope that I get paid the right amount of money at the end of it.
Great. And Eric, within Domo, what's the process for getting agreement on what the goals of the plan are, or is that just totally up to the CEO?
Yeah, I think it's probably. I mean, it's a long process for one. At least it feels like it. But I think there's a lot of collaboration, and for us at least, it kind of starts with more of the CFO and CEO as they, at least kind of where we are as a company, with the CEO and CFO deciding, what are the goals for the year as far as at least from a top line perspective. And then once we kind of know what those goals are or what we're thinking there, and usually I would say the head of sales is involved in that conversation with the CEO and CFO as well. But once we're kind of in agreement of what that goal is, at least from a top line perspective, then from there is when I would say FP&A, and then the sales side, our sales ops really in particular, and then some of the other sales leaders then start looking at it and saying, okay, if this is what we need to hit, how are we gonna hit these numbers? How are we gonna set quotas? Where were we last year? And what quotas do we need to be at to hit our numbers? What headcount do we need to add incrementally? And then from there, kind of work our way through the plan. And that's kind of our process. And then I would agree with Steve as far as the communication. I think as long as sales leaders, especially more at the manager level, are involved in the plan through the process, and there's good communication, and you explain and help sales leaders or sales individuals understand why the comp plan is the way that it is, I think that helps it run smoother. I think no matter what, it's always going to be tough, but that at least helps the process to be a little bit smoother and helps reps and managers understand the comp plan better, and I think buy into it a little bit more. But that's at least high level kind of my thoughts when we talk about this.
Mhm. Yeah, no, that makes sense. And I guess to follow up on that, I'd like to ask both you and Steve, if you think about, you need to figure out what the company's targets are in order to, because the sales comp plan is really a way to execute on the company's goals. So as a company, do you typically go through the budget, the planning and the budget process, and then rewrite or rejigger the sales comp plan? Do you try and do it in parallel? How does that work at Domo?
So Lawrence, I'm sorry, say that question again. I actually was looking at some of the questions that were in the chat here. But can you just restate the question one more time?
Sure. It's really a question of process. A lot of times people want to do everything all at once, but it sounded to me like you made a very good point that the sales comp plans are a way to execute on the company's goals. So usually you have to go through the budget and planning process. Lots of companies are going through that right now, and get agreement from the board on that before you start writing the comp plans, but then you have to launch in January with comp plans that you can explain to the sales organization. Do you have any, logically it's a sequential process, and it doesn't work as well when you're doing it in parallel and then the board doesn't approve the plan, and then you have to go back and change the budget or the targets, and then you also have to go back and change the comp plan. But believe it or not, that occasionally happens. Do you have any best practices in terms of how to handle that sort of sequential process? You need the information up front as to what numbers you're trying to hit.
Yeah, that's right. I think that's what creates a little bit of the challenge with it is the comp plan, as you said, is really, the point of the comp plan and point of sales is to execute on whatever the goals are. So at least for us, and so our fiscal year begins in February, so we'll probably kick off some sales planning / compensation in the next couple months. And as you said, we certainly won't have some of our top line goals solidified. So it's really iterative, and I think that's kind of what makes it challenging. And for us, it's kind of like the initial feeling from CEO and CFO of, hey, next year this is what we're thinking for top line targets, and then we start to execute based on saying, hey, we want our numbers to be this, or we want it to be 100% growth, or whatever the case might be. So how do we design our quotas, our sales force, and our compensation to hit those numbers? And this happened to us last year. It felt like all the way up until the end of the year where we had several changes. I think there's two things. I think one, if you're working really close, FP&A or finance with the sales force or sales operations, I think that you can pivot pretty well for the most part, especially if you're building models or tools or you're using some type of financial planning software that enables you to quickly pivot. And that was kind of the case with us. So we use adaptive planning for our financial planning software. And even though it felt like we changed so much, it was easy enough, at least on my side, to make those changes, say, in January or in December, to where then we could make some tweaks and say, okay, based on these new top-line targets, we need to hire some additional heads here, we need to adjust quotas there, and then in turn that kind of turned into the comp plan too. So there's probably not a silver bullet. At least I'd love to hear if other people had feedback on that, but I think that but that's at least been my experience, and you certainly kind of have to plan for probably a lot of changes along the way.
Mm-hmm. Steve, what have you found?
Yeah, so this is a top-down, bottom-up approach, as I like to look at it, and this is not a trivial undertaking. I think it all starts off with what do we need to do this year. So usually there's a percentage growth that you need to hit. The CEO and the board have said, well, guys, let's look at where we are and what we need to do, and kind of come up with a top-line number. Usually then what should happen from there is that number should be given to the head of sales to say, this is the number we're shooting for. Can you come back with a plan as to how you're going to hit it? So you take that and you do a top-down, and you start to say, okay, well, if that's what I'm going to do, then this is what I'm going to need. And what you will need to do, and quota and compensation planning comes right at the end. So what you'll look at doing is saying, okay, well, if that's the number, then this is how many reps I need, because based on the quotas, the numbers that people are able to hit, this is how I'm going to architect my team. You then roll that further up, and that gives you your demand gen kind of goals around what your BDR requirements will be based on what you think they can achieve. And then that goes further up the funnel to marketing and marketing goals. And then once you've understood all of those things, then you can come back and say, well, okay, well, these are the numbers that I need to hit. These are the number of people that I need to have in the team. And as a result of that, like, this is how much it's going to cost, because these people carrying this sort of a goal is going to cost us this much money. Usually what happens then is the CEO and the CFO come back and say, no chance, you can't have all that. You're going to have to work. And that's when you come together and start saying, okay, well, what's the give and take here? If you're going to give me this really big number to go and hit, this is how I told you I can get there using historical, conversion rates, sales cycles, ASPs of deals. What can we do? And then once we start to build out a headcount plan and demand gen goals aligned to that, then we have an operating model to get started with. And then from there, you start saying, okay, what is the compensation plan going to look at? How much can we afford to pay based on the number of heads that we have? So it's really about capacity planning up and down, starting with the high-level goals. And sometimes what happens is you come back and you agree that the goal that was originally stated is just not achievable because the marketing leader comes back and says, there's no ways I can hit those, MQL or MQA goals that you're going to hit me. So it's very much a negotiation.
Yeah. No, that's exactly right. I'm going to actually skip ahead to a slide, and I'll come back to sort of a summary of best practices. But because, in a sense, what you're both talking about is how do you come up with the magic formula for what the right quota is? You top down, bottoms up. The top down number is growth by 50, 100%, depending on what size company you are and how aggressive the goals are. And oftentimes it's not a perfect doubling or 150% of the sales organization, and plus you've got to ramp people and you have to give salespeople quotas that are doable, and or else you're going to have an awful lot of people, a lot of turnover, and spend a lot of your time hiring instead of out selling. So what have you found, Steve? And certainly Insight Squared as in a sense, a BI tool for looking at your sales productivity and CRM and teasing out information. I'd love to hear your thoughts on how you went about it at Insight Squared.
Yeah, I mean, it's an interesting one. This is where benchmark data is very, very valuable. You start to look at a ratio. At a starting point, you start to say, well, what can my guys do? What can my team do based on historical performance? And what we have to think about is, what is my conversion rate in my sales cycle? It's a starting point. So what is capacity for a rep? What does success look like? Sometimes we say, well, I think each rep should be able to do like 4 deals a quarter. And when you look at it, nobody's ever done that. So you take history to inform the past to say, well, if we think they can do 4 deals a quarter and our top performers are only doing 2, then hold on, something's not quite right. So you have to look at what has been transpiring in the past. And unless there is some material change to make you feel that you're going to, because we often fool ourselves. We kind of drink our own Kool-Aid, which is to say, we've got more reps now that are more ramped, we're going to do better. But if you take your top, say, 50% of reps from the previous period's performance, and you use that as a benchmark to say what, fairly decent looks like, then you can say what should we be able to expect from our individual reps, unless there's something that's revolutionary within your business that's going to change that. And then the other thing is looking at, like, there's a CAC implication, right? So we often look at round about a 4 or 5x multiple between quota to OTE. So, that gives you some idea of and it's all over the place. But, rule of thumb, a lot of the research that I've seen has shown that somewhere between 4 to 5 times is what you should be doing on your OTE. So, for example, if you're earning $100,000 a year on a full OTE, you should be able to have a quota of around about $500,000 of quota that is sustainable there. Then the other things you've got to look at is saying, well, who's doing the lead gen and how much is the lead gen costing me? And what is the ratio between BDR to AE? How much is going to be self-sourced versus channel to HubSpot versus BDR or marketing led? And if you have to have an overweight BDR team, that means the costs of acquiring the opportunities is high, and maybe you can't afford the ratio that I just explained, and the ratio has to be higher. Because the support infrastructure sitting around the salesperson is more heavily invested in. So all of those things come into play. And then the other thing that you have to be very, very mindful is, salespeople are guns for hire. And if they think that the quota is unachievable, and they know they can get a lower quota with a higher OTE somewhere else, then you can have staff attrition. So it's super, super important that you take into account not only your economics within your own business, but you have one eye on the broader market out there, so you can at least have sort of some level of parity with what the going rates are.
Yeah, I think that's very true, and I think I'll just jump in before getting Eric's thoughts about this. But in terms of benchmarks, there's benchmarks that you can look at in all different ways. You can look at exactly what the quotas are, or the quota to OTE ratios are in research, like what OPEXEngine does, or in terms of some of the specific salary position benchmarks and that kind of thing. But another thing that we look at OPEXEngine is, total expense per person in sales and total comp and benefits per person in sales. And I mean, just taking, for example, it used to be that a sales budget, 98% of a sales budget was comp and benefits. And we see now, maybe a benchmark around 85%. So you have another 15% of the sales budget that's being spent on systems to help the salespeople be more efficient, typically, plus training and that kind of thing, and investment in sales resources. But we see, if we sort the data by the fastest growth companies, if we take the SaaS sector of private companies, the top 25%, I mean, they're spending something like 35% of the sales budget on things outside of personnel, so training and systems and things like that. So part of the reason I think that they can have higher quotas and higher productivity is because they're making their people that much more efficient. And you have to take that into account as you think about, what have my salespeople done in the past? Well, it's a question of product market fit, but it's also a question of, what kind of tools are you investing in for the salespeople? And sometimes sales, funny enough, invests a lot on compensation and less on tools, and that may not pay off as well. But Eric, what do you think about setting quotas?
Yeah, so I think I would agree with what Steve has said. I mean, I think we're probably in the same boat. And one thing I'd say for sure, in the whole compensation process, the benchmarks are awesome. I mean, if you're a new company, startup type company, growing company, the benchmarks are really useful for, one, to get buy-in from sales team or whoever it is, and then two, to help you actually set the numbers, just because you don't have a lot of historical data. But for us, as we're setting quotas, I think it's really it's kind of a bottoms up and tops down approach for us as we get the targets for the year. It's kind of a combination of, one, saying, okay, what's reasonable based on our performance the prior year and some other things, other variables that we know about. What's reasonable to increase a quota, and what can they actually achieve, and then what's going to help us get to that top line number. And I think, as Steve pointed out, in some cases, and that was the case with us this year, as we changed our top line goal a handful of times. As you work through it, and as you kind of do more of a bottoms up and look at history, conversion rates, and performance, you just say, hey, I mean, there's not really a way to hit those numbers unless we have some big changes here, and here. And I think, as Steve pointed out, you can raise your quota to whatever you want, but it doesn't necessarily mean they can actually get that, and then you look at larger attrition. So for us, we kind of look at a lot of different things, and certainly try to stretch a little bit and look at the performance from the prior year to get quotas probably to where they should be, in combination with benchmarks, and then hopefully to our top line goal. But it's definitely kind of a combination of both, and certainly iterative as we go through the process and kind of run through the numbers and see where we're at and see how quickly we can ramp certain heads the following year.
Yep, definitely. Well, since we're coming closer to the top of the hour and I want to make sure that we get questions from the audience, I'm going to run through the next two things super quickly, but we found in the research, for example, that variable percentage of OTE for new account reps in general ran about 50%, and that was true, we found, for small companies, large companies, regardless of size. Renewal percentages, variable percentages, funny enough, for early stage companies were, a smaller variable, more in the 30 to under 40% of OTE, but for larger companies, oftentimes the variable for renewal reps was higher, closer to 50%. And then comp plans for BDR or inside sales, lead gen, times is not tied to specific revenue, but tied to activity, number of MQLs or number of appointments set, that kind of thing. Can you, Steve, quickly talk about the different structures of comp plans for these three different areas, different positions?
Yeah, sure. And apologies if you hear some hammering. I'm in a room where there's a builder on a scaffolding right at the window. So typically the reps, the new logo folks who we want out there hunting and winning new logos, they are on around about a 50%, so 50% of their total OTE is base, and the other 50% is at risk based on their performance, and we've spoken about some of the structures of that. The word CSM, Customer Success Manager, seems to be now become more mainstream, but it's a relatively new term. We used to call it account managers in the old day, and that I think CSM is an interesting role in that some people are having them be non-commercial oriented folks who are responsible with customer well-being, and sometimes they do renewals, sometimes they do upsells, sometimes they do cross-sells, sometimes they do nothing but make sure customers are happy campers. So there's a number of different ways of doing that. I think a traditional CSM is weighted more heavily on the base with some level of compensation, usually is tied to the renewal rate. I have a preference, actually. I prefer to remove relationship from commercial because sometimes commercial introduces tension in the relationship. So I like the play which has a CSM, a Customer Success Manager, who is responsible for exactly that, customer success, renewals, and customer well-being. And they're compensated usually a higher percentage on the base, but on the variable there's a few things that you can goal them on. One is finding new opportunities within existing accounts that they then hand over to a commercial person, an account manager perhaps. Similarly, customer churn, maybe NPS scores and the like. So it's all about making sure customers are happy, but you also want them to be motivated to uncover new opportunities within those accounts. And then an account management function who runs a renewal and upsell type process. Sometimes the new AEs do this, but I prefer to keep them separate because it can be distracting. But those folks are doing all the commercial. So when you're trying to get beaten up on a renewal, they can come in and be trained as negotiators. And similarly, when they're introducing new products, goods, or services they're selling to existing accounts, they're in there to do the deal and get out. And a CSM is the one continuing consistent person that's in there. So it's just my thinking on that, my preferred route. And then as it relates to BDRs, SDRs, and the like, one of the things I would caution everyone with these folks is they tend to be very early on in their career, and they tend to want to progress very, very quickly. So as you start thinking about compensation plans, I would encourage you to have not a static compensation plan that's going to be static for, say, the 12 to 18 to 24 months that they're going to be in the role. I would encourage you to think about hurdles for them to achieve where they can have little victories and maybe get slight bumps on their plan on every 3 to, say, 6 months. So they're seeing light at the end of the tunnel. And one way of doing this is perhaps through the first maybe 6 months of this is the play that we ran. First 6 months, they were purely goaled on creating opportunities. fees as defined by our sales process. And then once they had achieved certain goals, they graduated to another level, and they continued that. They still got paid on the same goals there, but they also got a little bit of a kicker in that the deals that they sourced, they got a percentage thereof, which made them focusing not just on opportunity generation, but also the quality of those opportunities. And they were super interested in how the AEs were doing on those opportunities. That's the kind of how we.
Yeah, Steve, that's great. It's great to see your philosophy behind the structures. Eric, do you want to talk quickly about Domo's different structures for these different positions?
Yeah, sure. So, and I'll be quick. I know we're getting short on time here, but yeah, for our reps, their compensation, similar to what Steve said, we're actually a little bit north of 50% on the variable side, but it's probably more like a 60-40 or so, just depending upon the rep. And then our CSMs, kind of the way we view CSMs, and honestly, we're kind of evolving a little bit with the CSMs, but the CSMs are they're about a 30% variable on their OTE, and the way we incentivize the CSMs is that each CSM will kind of get their book of business for the quarter, and then they're compensated based on how much they renew. And so there's a goal that's set, and then they're able to get kind of bonused out on how much of what their renewal rate is of the book that they had that was up. And then in addition to that, since our reps are compensated on new logo as well as upsells, at least right now, the CSMs also have a little bit of incentive in there. As they work with customers, if they were to get an upsell, they have some bonus structures in place as well in order to get some sort of bonus if they're able to upsell a customer, and it has to meet a certain threshold. But that's kind of how we work our CSMs. And then on the inside sales side, similar to what you said, it's more based on units, on sales qualified opportunities. I think there's a lot of challenges with the inside sales, and we've tried different things. We actually, at one point, and they're about 50-50 on their OTE, and they're just, at least currently, we just compensate on opportunities that they generate. Last year, we actually their variable was entirely on ACV, so it was just tied to opportunities that they generated that then turned into ACV, and it ended up kind of being a nightmare. I mean, I think it was, on paper, it sounded really good, but there was a lot of challenges, and I could certainly talk to that if someone had a question about it later on, but we kind of had a lot of problems with that. I think it made sense, but then in the end, it was kind of a pain with administration and trying to figure out how to get compensation to them before a deal closed because of the sales cycle, et cetera. So, yeah, that's kind of, I mean, we could talk about ADMs or inside sales a long time, because I think you can easily incentivize the wrong things, and if you don't have proper accountability and policing and accepting different opportunities, then you can kind of get out of control a little bit with your compensation on the inside sales piece. But in a nutshell, that's kind of how we're structured.
Yeah. No, it's interesting, and you're right. We could do a deep dive on each of these topics, I think. I'm going to, I think you both touched on the issue about customer success and versus straight renewal reps. And to be honest, we see every different type of structure out there. Customer success as a position overall is a new position in a sense versus renewal. We see companies that have straight renewal people sitting in admin or finance that aren't even part of the sales organization, and they're really just renewing subscriptions and following up on that. So they're not comped as salespeople. We see renewal and customer success managers sitting in sales. We see them sitting in a separate area, sometimes under professional services, sometimes some other part of the company, and disassociated from revenue. For the finance folks, it can cause quite a challenge, because it really, where you put the expense of these people, is it an OPEX or is it a COG? We actually have a white paper on our website that talks about that more. So in our last slide, I'm just going to talk really quickly about or ask you questions about comp plan administration, because that's also, I think I saw some other research out there recently that about 80% of companies say, and this is overall, say that they continue to struggle with managing their sales comp plans. Steve, do you have some best practices there and ways that you found work best in order to, make it easy, make the salespeople trust in the numbers and not have a lot of going back and digging in and trying to figure out, was this paid out correctly or not?
Yeah, I think one of the key things is as early as possible, provide your individual sales reps with a comp calculator. Obviously, what you want to do is present the plan, give them an example so they can play around and see what it looks like. Because invariably, they want to see how does this plan stack up to how they performed last year, where they've made more or less money whenever there's a change. Then on a month-by-month basis, give them a compensation calculator such that they can very quickly do it. And you'll be surprised, like everyone in finance, nobody's perfect. Mistakes are sometimes made. So in our instance, the finance team would do the compensation calculations. They would send it over to the sales leadership group to double check it, and then it goes over to the individual reps. And the final check and balance from the reps is good. It also shows full transparency, and just keeps them involved in the process. But you don't want them building their own spreadsheets to do all this sort of stuff. So compensation calculators are great. There are some really good tools. I was never fortunate enough to use any of them. We were always doing manual ones. I know Eric said he had a good tool that he was using for this, to help them sort of optimize this.
Eric, what tool are you using there? And
well, so we actually we just implemented Obero, which I think relatively new company. We had Exactly previously, which we actually kind of ran into some challenges. But I think that's a big part of. I mean, there's always going to be complications with compensation, and no matter what, it seems like there's always 100 questions at the end of every month. But I think, one, if you keep the plan relatively simple, if you add in so many complexities and so many different ways to make money, then you're just going to get a ton of questions every single month because it's hard to follow the plan and really understand. So I think that simplicity is definitely a big part of it. And then in addition, I think you'll save yourself a lot of time and money if you put a system in place instead of just using Microsoft Excel or running your commissions analyst into the ground trying to recalc stuff and true things up. If you implement something like an Obero or another commissions tool, I think it's definitely worth the money. It'll probably pay for itself within a year. And the main thing is one, you have less mistakes. Because even working in Excel, you're going to have mistakes. You're going to have problems. And then in addition to that, there's always true-ups. There's always things that change. Even as you want to change a plan, when you have a system in place, it just makes it that much easier, and it's easier to roll it out, those changes after the fact if you have a software that actually does it. So I think that's a big part, and if you can do it, that's worth the money in my opinion. And it's not, it's not that much. So.
Yeah, I think, and the other value of it is that you can make sure that you're always consistent, because if you're doing it manually in Excel, you might do something for one rep and forget to make that tweak with another rep, and that's, the worst possible thing you can do is to pay two reps who should be on the same plan slightly differently. But
yeah, that's right.
I'm sorry that we're running up against the end of our hour here. We could keep talking for another hour or two. This is such a great topic, and you both have been fabulous presenters. I want to invite the audience to send in any further questions that they have, and anybody who is obviously not part of the OPEXEngine benchmarking data form and you would like to find out more information, feel free to contact me or go to www.opexengine.com. We love to work with as many companies as possible because then we have more data and we can do a better job supporting everybody. But thank you so much, and thank you to our presenters.
Sure. Thank you.
Well, thanks, guys.
Thanks, Eric. Thanks, Steve.